There is a single thought, quiet, reasonable, almost comforting, that costs investors more money than bad stocks, bad timing, or bad luck. It doesn't sound reckless. It doesn't feel emotional. In fact, it usually sounds like intelligence, like patience. And that's exactly why it's so dangerous. Once this thought takes hold, it quietly rewires how you see risk, time, and your own decisions. Imagine an investor watching the market fall. Not a dramatic crash, just a slow, grinding decline. At first, they feel calm. They tell themselves a familiar, responsible story, so they hold on. Weeks pass, then months. Losses deepen. Still, the story holds. And that's the problem. This thought doesn't panic you. It comforts you. It gives emotional relief precisely when uncertainty is rising. And that relief is addictive. The human brain hates ambiguity. When something painful happens, like watching your money decline, the brain rushes to reduce that discomfort. This thought does that instantly. It transforms uncertainty into reassurance, risk into patience, doing nothing into virtue. Psychologically, it's a sedative. You don't have to decide. You don't have to act. You don't have to confront the possibility that your assumptions are wrong. You can just wait. And waiting feels safe. But safety is not the same as correctness. This illusion is powered by a cluster of biases: the belief that the future will resemble the past, the tendency to seek evidence that confirms what we want to believe, and the fact that realizing a loss feels worse than just watching it happen on paper. Together, they create a powerful lie that not deciding is safer than deciding. This thought is a chameleon. In a rising market, it whispers, "Why change anything? What's working will keep working." So your risk slowly creeps up. Your portfolio gets concentrated. In a falling market, the same thought whispers something else. Don't interfere. Just let time handle it. So your losses deepen. Your capital erodes. Notice the pattern. It always argues for comfort. It always resists adjustment. And it always feels reasonable, right until it's too late. The cost isn't a dramatic flameout. It's a slow underperformance, missed opportunities. Years later, investors look back confused. They were patient, they stayed calm, so why didn't it work? Because comfort is expensive, and the market charges compound interest on psychological mistakes. Disciplined investors think differently. They don't worship patience, they worship a process. They ask, what would invalidate my thesis? What conditions require me to adjust? Am I waiting because it's rational or because it feels good? They understand time does not heal bad assumptions, only evidence does. They are willing to feel uncomfortable sooner to avoid permanent damage later. So, what is the thought? It's simple, almost harmless. It sounds like wisdom itself. If I just wait long enough, this will work out. Not might, not could, will. That certainty is the trap. To neutralize it, you have to replace it with better questions. What am I assuming must happen for this to work? What would a rational outsider do right now? And most importantly, am I holding this because of my analysis or because of the relief it gives me? Discomfort is not the enemy. Unexamined comfort is. Markets don't punish emotion. They punish unchecked emotion, disguised as logic. And the most expensive thought an investor can have is the one that lets them feel safe without being right.